Okay, so I'm going to talk about how to plan your exit at the time of entry. And some of you seem to realize the importance of this. H. Pandit asked, how do you plan your profit taking and trade management before entering a trade? And this is something I always post on my tweets as well. Whenever I take a new entry, I'll usually post where I'm going to exit or how I'm going to trade it. I'll show you examples of that as well. Another example is these sorts of questions that I get asked quite frequently, which is my issue is if I hold stocks, then they retrace from 5 to 10% and go back to break even or worse. But if I don't hold stocks, then they go up 20 or 40%. So I never know what should I plan, think, or train myself to do. Basically, a lot of you have been asking, how do I determine the magnitude of my trades? And how do I plan this at the time of entry? So in this video, I hope to make that very clear, very logical, and show you examples of how I do it. So at the time when I am entering a trade, I ask myself a simple question. Is this going to be a position trade or is it going to be a swing trade? What is the criteria for a position trade? It's these three. Either the stock has a major EP, and I'll go through a few examples, or the stock is a recent IPO that's breaking out of an IPO base. I'll show you an example of what that looks like as well. Or we're at the start of a new bull market. So, and I'll go through examples of those as well as discuss if we're in one right now. So these are the only three cases in which I'm going to treat a trade as a position trade. Now, in all other conditions, I'm going to take a trade and treat it as a swing trade. And I'll discuss what exactly the rules for selling a position trade and a swing trade are. Just hold on. I'm going to first go through the criteria for how to determine which is what. So in all other conditions, every trade I take is a swing trade, plus in every biotech's case, it is a swing trade, plus if you need to build portfolio traction, if your account, which means your account is not doing well, you haven't got a lot of profits this year, or we're in a bear market or a choppy market or a late stage bull market, and these are times when it'll be very difficult to build portfolio traction. Those are other times when I will be swing trading. Or if there's an upcoming news event, either about that particular stock or for the market in general, like say an FOMC or an election. I'll go through examples of those as well. Just keep these in mind for now. I'm going to go through examples of each point. So hopefully it'll be very clear by the end of the video. But this is something that I have written down and printed out and put up on my desk. So I always know at the time of entry whether I should treat the trade as a position trade or as a swing trade. Just a side note, in case you're a complete newbie and wondering what position trading and swing trading even are, then a very simple definition is position trades are much longer term trades that you hold for a few weeks to months, and swing trades are trades that you hold for 3 to 5 days at most. So just keep that in mind, but I'm going to go through the exact sell rules for each in a later section. Okay, so first let me take you through examples of each of these 6 conditions so you know what they mean. The first is if a stock has a major EP, or that means episodic pivot, then you're going to treat it as a position trade. Now, episodic pivot is a term that was coined by Pradeep Bonde over at StockB, and I got to learn of it through Kulamagi, who was one of his students that went on to make 100 million. And this is one of his favorite setups as well. This is a super powerful setup, which basically means that a stock has a really strong catalyst or news or earnings that come out which completely change the growth trajectory of that stock. So Peloton, for example, in May of 2020, released earnings on this day, and I can show you what the news looked like and what the earnings were. So on this day in the pre-market, we had news, a lot of positive news about Peloton and everyone talking about how the sales have gone up 66%, etc., because everyone was staying at home and buying Peloton bikes. And if I were to buy a stock on this day, because I find this news really positive, I would treat this as a position trade and hold it for a much longer time. So this is something for which you don't have a formula, but this is very subjective, and you have to use your common sense about whether a particular catalyst or news is a game changer for a company or not. And if it is, then treat it as a position trade. Now, the other case in which you would treat a trade as a position trade versus a swing trade is if a stock is breaking out of an IPO base. So if you have a recent IPO, say within the last year or two, and it's forming this base, like in this case, Duolingo has just been going sideways for more than a year. And at this level of $113, it's just been finding resistance. On this day, it reported earnings and it had a huge gap up. It broke above the $100 mark and it reported huge subscriber growth or huge revenue. This was a stock that I also traded and might have made a few tweets about as well. In this case, when I see that it's a new stock, not many institutions own it, and it's just come out with really positive news, I want to hold it for a much longer time, and so I treat it as a position trade as opposed to a quick swing trade. Okay, now the third condition for when I would position trade versus swing trade is if we're at the start of a new bull market. So a bear market technically is when the indices go down 20% or more. And once that happens and the market starts to turn, it usually has the potential to roar back and go up 100% or even more. So this is the chart of the NASDAQ in the last 15, 20 years. And let's look at the bear markets. This one lasted a year and the market went down 55%. And as soon as it bounced back, for the next 10 years, the NASDAQ went up 600%. This was another short bear market of 20%, which only lasted 3 months. And when the market snapped back, it went up from this low to this high, 65%. This was the COVID crash that I'm sure you guys all remember. Here, the market went down 30% in a month and a half. And when it snapped back from here, we went up 150% in the NASDAQ in a year and a half. So as you can see, when we snap back from a sharp drawdown of more than 20%, usually there's the potential for the indices to keep going up and make really big gains. And this is a time when, again, you want to focus on position trading and capture those huge moves versus swing trading and letting go of the stocks too quickly. So where are we right now in the indices? We've been in a bear market of more than a year, and we've been down 37% on the NASDAQ, which is a pretty significant bear market. So based on market history, we can anticipate that if we were to start a new bull market, it would be a pretty strong, pretty long-lasting bull market for a year or more. And you would want to hold on to your positions for a much longer time through these. So let me show you a chart of the Qs zoomed into just this current bear market and where we are right now. As you can see, for the last 1 year, we've been in this downtrend of making lower lows and lower highs. And if you draw a simple trend line, it's been going down. What's happened since October is this trend has changed. So we've been making higher lows. So this low, and then this low is higher, and then this low is higher, and then this low is higher, and higher highs. So every high is also higher than the previous one. So this is a classic uptrend. And we've already bounced around 20% of the lows. So there is a very good chance, just purely based on technical analysis, that since we're in an uptrend and have gone up 20% and have broken this downtrend and are above all the moving averages, we might be starting a new bull market. So this is a time when you can think about holding positions for longer if you're anticipating that the bull market does start and we rally for another year or two and the market makes some spectacular gains. So these are the 3 conditions in which I would consider position trading. To recap, one is if a stock makes an EP, like Peloton. 2 is if the stock is a new IPO that's breaking out of a base, like Duolingo that I just showed you. And 3 is if we're starting a new bull market. So in all other conditions, I want to be doing swing trading. And there are also some exceptions to this. So let me go through those now. First thing, this is something you definitely must remember and write it down, is if you're trading a biotech, you only want to be swing trading it. Now, why is this? In the US, biotechs are extremely volatile and extremely unpredictable. They'll frequently gap up and gap down. And look at this example of a random biotech that I picked, which frequently gaps down 25-30%. This is not unusual at all. In fact, this is the norm in the world of biotechs. Since you don't want to risk being caught in any of these gap downs, it's best that you hold your biotech stocks for as short a duration as possible, so you're minimizing that risk. So every time I have a biotech stock, I am selling it into strength and taking my profits in 3 to 5 days, which means I'm treating it as a swing trade. And I'll go through the exact sell rules for swing trades, but just remember, if the stock you're buying is a biotech, it's a swing trade, not a position trade. Okay, the second exception is if you need to build portfolio traction, then you're going to swing trade and not position trade no matter what. Now, what do I mean by portfolio traction? It means if my account has been going down, so say this is the usual equity curve, and this is what all of your equity curves should look like if you are a consistently profitable trader. As soon as you start to get drawdowns, or you're just going sideways and your account has no traction, look at these long periods where the account just goes sideways, you're not getting any traction. Say you're down on the month, you're down on the quarter, you're down on the year, your account's not moving anywhere. Those are times when you want to be swing trading and quickly booking those profits and racking up gains as opposed to position trading. So usually your portfolio is not going to get traction if you're in a bear market or a choppy market or a late stage bull market. So for the last 1.5 years, or rather 2 years, since we were first in a late stage bull market, then we went to a choppy market, and then we transitioned to a bear market, my account has pretty much been this way. This is not an actual screenshot of my equity curve, but this is what it pretty much looks like since the time I became profitable. And because right now I'm currently just going sideways and actually even down, and I don't have any traction in my account year to date, I'm actively swing trading, and very rarely will I take a position trade, because first what I want to do is rack up some gains and start to make my equity curve go up. That is our first and foremost job as a trader, which is we want to build that profit. We want to build that cushion for the year, and then we can start to hold positions for longer. So in case you're confused about what portfolio traction is, or how I size my trades, or how to make sure that your drawdowns are just sideways or just single digit low drawdowns, check out the video that I made on position sizing and progressive exposure, because that is the number one thing that's going to determine your success as a trader. That is even more important than sell rules. And what I do in that video is try to take you through an example using hypothetical trades and talking about how your total equity would change and what the changes in the P&L would do to your equity curve. So before you ask me questions on what portfolio traction is and how to go about thinking about it, please check this video out. Okay. Now, the other exception for when you should swing trade and not position trade is if there is news and events. So what do I mean by that? There is a news calendar for all US news events and announcements. It's on MarketWatch, and I can even link it in the description below. But basically, you want to check that. And the big daddy for all of these events is this, the FOMC meeting. FOMC is the Federal Open Market Committee meeting. This is where the Fed announces whether it wants to increase rates or decrease rates. And in an environment like we are in right now, where we have 40-year high inflation and the rates are extremely high, every single FOMC meeting minutes moves the market up or down. So the catalyst itself might change from time to time. Like during COVID, it was, death numbers from COVID, and that data used to come out and move the markets around. And right now it's inflation data, like the core CPI, or it's the FOMC minutes, like the current market rates. But regardless of what the catalyst is, you want to be swing trading when there's an impending news and not position trading, because your risk increases greatly. There is no way that you or I, who don't know the Fed chair personally, can know anything that he's going to do. So rather than holding all of our open profits at the mercy of J. Powell, we go in defense mode and we start to book profits. So I got a great question last Tuesday rather, about right before the FOMC was coming out, about how do you prefer to manage positions around data of Fed events? Like this week, we have CPI, PPI, bank earnings, things like that can move the market. I tend to go flat into those events and just reevaluate after, but curious on your thoughts. So what I simply do is play defense. So I won't have more than 1 or 2 positions that are not already profitable in my account. And I start to take partial profits to build up cushion in my account. And I give the example of Mara, which was a trade that I was in at that point. So in short, I'm reducing exposure and building cushion. And if at a time like this, I'm taking any new trades, it's definitely going to be a swing trade and not a position trade. And that's simply because you don't want to increase your market risk. Okay, so hopefully that makes sense. And let me just go back to show you the chart. Hopefully you have a better idea of what are the criteria for when you would take a trade as a position trade and the criteria for when you would take a trade as a swing trade. Okay,